The dollar just dropped below 57%, 56.92% of global reserves to be exact. That's the lowest reading in years, and it happened in just 3 months. The euro, it's surging, 20.33% now. The Japanese yen is climbing too. And if you think this is just another quarterly blip, another routine IMF report that doesn't matter, you're missing what's really happening here. Because central banks around the world, the institutions that hold trillions in reserve assets, they're quietly, methodically reducing their dollar exposure. And they're doing it right now. Listen, this didn't come out of nowhere. The International Monetary Fund released this data on Friday, and most people scrolled right past it. But here's what you need to understand. When the world's reserve managers start shifting allocations away from the dollar, even by a few basis points, that's not random. That's a signal. That's a trend. And trends like this, they don't reverse overnight. They accelerate. Now, before we go deeper, let's zoom out for a second, because if you want to understand where we're heading, you need to know where we've been. The dollar has been the world's dominant reserve currency since Bretton Woods in 1944. For 80 years, nearly every major transaction, every commodities trade, every sovereign debt purchase, it's been denominated in dollars. Countries needed dollars to buy oil. They needed dollars to settle international trade. They needed dollars because everyone else needed dollars. That's the network effect. That's the moat. And for decades, that moat seemed unbreakable. But here's the thing about reserve currency dominance. It's never permanent. History shows us this again and again. Before the dollar, it was the British pound. The pound sterling was the king of global finance for over a century. From the 1800s through World War I, if you wanted to conduct international business, you used pounds. London was the center of the financial universe, but then 2 world wars, massive debt, economic decline, and by the mid-1900s, the pound's share of global reserves had collapsed. The dollar took over. The transition took time, sure, but once it started, it was inevitable. Go back even further. Before the pound, it was the Dutch guilder. Before that, Spanish silver. Reserve currencies rise, and they fall. The question is never if, it's when. And what replaces them? So now, in late 2025, we're watching something fascinating. We're watching the early stages, and I mean early stages, of a potential shift. Not a collapse, not a crisis, but a slow, grinding erosion of dollar dominance. And the data we just got, it's another data point in that story. Let me walk you through the numbers because this is where it gets real. Third quarter of 2025. The dollar's share of allocated reserves dropped to 56.92%. That's down from 57.08% in Q2. Now, on the surface, that looks like nothing. 16 basis points. A rounding error, right? Wrong. Because this follows a brutal second quarter where President Trump is tariff actions threw global FX markets into absolute chaos. Central banks had to react. They had to rebalance. And when the dust settled in Q3, they didn't rotate back into dollars. They held their new positions. The euro, meanwhile, climbed to 20.33%. That's up from 20.24%. Small move, but it's directional. It's additive. The Japanese yen jumped from 5.65% to 5.82%. Again, not massive, but it's movement. And all of this happened during a quarter that Goldman Sachs described as showing stabilization in reported reserves with only minimal shifts. Minimal shifts. That's the key phrase. Because if reserve managers were truly confident in the dollar, if they believed in U.S. fiscal stability and policy credibility, they would have rushed back in after Q2's volatility. They didn't. They stayed diversified. They leaned into euros. They leaned into yen. They said quietly, through their actions, we're not putting all our eggs in one basket anymore. Now, Goldman Sachs analysts, they put out a note on this, and here's what they said. They said that for both dollar and euro reserves, their FX valuation adjustment suggests that reserve managers leaned into currency market fluctuations. Let me translate that. When the dollar weakened in Q2 due to Trump's tariff chaos, central banks didn't panic sell. But they also didn't buy the dip. They used the volatility to reduce concentration risk. They diversified. And in Q3, when things calmed down, they didn't reverse course. That's the tell. That's the behavioral shift we need to pay attention to. And there's another technical detail here that matters. The IMF updated their methodology in this latest report. Before, there was an unallocated category for countries that didn't provide complete reserve data. Now, the IMF is filling in those gaps with new estimates. And they applied this retroactively all the way back to the year 2000. So some of the historical data got tweaked. Nothing major, nothing that changes the overall trajectory. But it does mean that the reserve composition we're seeing now, it's more accurate than what we had before. The picture is clearer. And what that clearer picture shows is the dollar's grip is loosening. Here's where we need to go deeper. Because the question everyone's asking is, why? Why now? What's driving this? And the answer is, it's multifaceted. It's not just one thing. It's a confluence of factors that are all hitting at once. First, there's the Trump tariff situation. In Q2 of 2025, President Trump, in his second term, started rolling out aggressive tariff policies, trade wars, protectionist measures, threats against traditional allies. This created massive uncertainty in global markets. Currency volatility spiked. And central banks, especially those in Europe and Asia, they had to ask themselves a hard question. If the US is going to weaponize its economic dominance, if it's going to use tariffs and trade policy as blunt instruments, do we really want 70-80% of our reserves in dollar-denominated assets? Because that's concentration risk. That's geopolitical risk. And central banks, their job is to minimize risk. Second, there's the fiscal situation in the United States. We just had the Bureau of Labor Statistics report that the Consumer Price Index climbed at a 2.7% annualized rate last month. Inflation is cooling, yes, but the broader picture is concerning. The U.S. is running massive deficits. The national debt is at historic levels. And this week alone, the Treasury is auctioning off $183 billion in new bonds, $69 billion in 2-year notes on Monday, $70 billion in 5-year notes on Tuesday, $44 billion in 7-year bonds on Wednesday. That's a lot of new supply. And when you flood the market with supply, yields have to rise to attract buyers. The 10-year Treasury yield is sitting above 4.16% right now. The 2-year is at 3.49%. The 30-year is pushing 4.85%. Those are elevated levels. And for foreign central banks watching this, they're thinking, if U.S. yields keep climbing because of fiscal concerns, if the debt trajectory doesn't stabilize, the dollar might weaken further. And if they're holding trillions in dollar reserves, that's a problem. Third, there's the rise of alternatives. The euro has been strengthening. The European Central Bank, despite its own challenges, has been relatively stable compared to the Fed's recent policy gyrations. The yen is gaining traction as a safe haven currency, especially as Japan's economy shows signs of stability. And beyond traditional currencies, we're seeing increased interest in gold, in digital assets, and bilateral trade agreements that bypass the dollar entirely. China and Russia have been pushing for de-dollarization for years. Saudi Arabia is discussing oil contracts in yuan. India is buying Russian oil in rupees. These are all small moves individually, but collectively, they represent a shift in the global monetary architecture. Think about it this way. If you're a central bank in Brazil or Indonesia or South Africa, and you're watching the U.S. engage in unpredictable policy actions, fiscal expansion, and currency weaponization, you're going to diversify. You have to. It's fiduciary duty. And that diversification, it shows up in the IMF data. It shows up as the dollar's share dropping from 57.08 to 56.92. It shows up as the euro's share rising to 20.33. It shows up in the yen climbing to 5.82. Now, let's be clear about something. The dollar is not collapsing. This is not a crisis. The dollar is still by far the world's dominant reserve currency at 56.92%. That's more than double the euro's 20.33%. The dollar is still the most liquid currency in the world. It's still the currency of choice for international trade. It's still backed by the largest, most dynamic economy on the planet. So anyone telling you that the dollar is about to be replaced tomorrow, they're wrong. That's not what's happening here, and this is a big, but the trend is unmistakable. The dollar's share of global reserves has been declining for years. A decade ago, it was over 60%. Now it's below 57%. That's a multi-year trend. And trends like this, they don't stop on a dime. They continue until something fundamentally changes, until U.S. fiscal policy becomes more sustainable, until geopolitical tensions ease, until the alternatives stop looking attractive. And right now, none of those things are happening. So what does this mean for you? What does this mean for your portfolio, your strategy, your financial planning? Because that's what really matters, right? The macro trends are interesting, sure, but how do you position yourself to benefit, or at least protect yourself, from what's coming? Here's my take. If the dollar's dominance is slowly eroding, if central banks are diversifying away from dollar assets, that has implications. First, it means the dollar could weaken over time. Not crash, not collapse, but a slow, grinding depreciation against other major currencies. If you're holding significant dollar-denominated assets, you need to think about currency hedging. You need to think about international diversification. Maybe you allocate more to European equities, to Japanese stocks, to emerging markets that benefit from a weaker dollar. Second, it means U.S. Treasury yields could stay elevated or even rise further. If foreign central banks are buying fewer treasuries because they're reducing dollar reserves, who's going to buy all this new debt the U.S. is issuing? Domestic buyers. And domestic buyers are going to demand higher yields to compensate for the risk. So if you're in bonds, you need to be tactical. Short duration, high quality, and be ready to adjust as yields move. Third, it means alternative assets become more attractive. Gold has historically been the anti-dollar trade. When confidence in the dollar wanes, gold shines. We're already seeing that. Central banks have been accumulating gold at record levels over the past few years. If you don't have gold exposure in your portfolio, now might be the time to add some. Not as a speculation, but as an insurance policy. 5–10% of your portfolio in physical gold or gold ETFs. That's prudent diversification. And fourth, it means you need to think globally. The days of just owning the S&P 500 and calling it a day, those days might be ending. If the global monetary system is rebalancing, if power is shifting from a unipolar dollar world to a multipolar currency world, you want exposure to that transition. European stocks, Japanese stocks, Asian markets, commodities, real assets, things that hold value regardless of which currency is dominant. But here's the thing, and this is critical. You can't panic. You can't make reactionary moves based on one IMF report. This is a slow-moving trend. It's going to play out over years, maybe decades. The smart money, the institutions, the family offices, they're not dumping all their dollars tomorrow. They're gradually, methodically rebalancing. And that's what you need to do too. Gradual, methodical, disciplined. Don't go all in on euros because the euro's share rose from 20.24 to 20.33%. That's not actionable. But do consider adding international diversification if you're currently 100% US-centric. Don't sell all your treasuries because yields are rising, but do think about shortening duration and being more tactical. Don't bet your entire portfolio on gold because central banks are diversifying, but do add some gold as a hedge against currency debasement. The key is be aware, be informed, be positioned for multiple outcomes, because the reality is nobody knows exactly how this plays out. Maybe the dollar stabilizes at 56% of global reserves and holds there for a decade. Maybe it drops to 50% over the next 5 years. Maybe some external shock, some crisis, sends everyone rushing back into dollars and the trend reverses. We don't know. But what we do know is that the direction of travel right now is clear, and it's pointing away from dollar concentration. So here's the bottom line. The dollar just fell to 56.92% of global reserves. The euro is rising. The yen is climbing. Central banks are diversifying. And the trend that started years ago, it's continuing. This is not a crisis. This is not the end of the dollar, but it is a shift. A slow structural shift in the global monetary order. And if you're paying attention, if you're positioning yourself intelligently, this is an opportunity to diversify, an opportunity to hedge, an opportunity to build a portfolio that's resilient no matter which currency ends up on top. The question is, are you ready? Are you positioned for a world where the dollar is no longer as dominant as it once was? Drop your thoughts in the comments below. Tell me, do you think the dollar's decline is accelerating, or is this just noise? And if you want to stay ahead of these macro shifts, if you want to understand what's really moving markets before the mainstream catches on, hit that subscribe button. Because at Economy Decoded, we don't chase headlines. We analyze trends, we follow the money, and we help you navigate the most important financial shifts of our time. You can find the links to all the sources used in this video in the description box. Now, before we go, The standard disclaimer: nothing in this video constitutes financial advice. This is educational content designed to help you understand macro trends and market dynamics. I am not your financial advisor. I don't know your personal financial situation, your risk tolerance, or your investment objectives. Any investment decisions you make are your responsibility. Do your own research. Consult with a licensed financial professional before making any major portfolio changes. Markets are inherently risky, and past performance does not guarantee future results. Diversification does not ensure profit or protect against loss. Understand the risks before you invest.